The Social Security Administration sends millions of letters every year, but there are 5 things buried in their own rules they will never proactively explain, and one of them could be quietly costing you tens of thousands of dollars over your lifetime without you finding out. The first thing is about money the SSA takes from you and what happens to it afterward. If you claim Social Security before your full retirement age and you are still working, the SSA applies what is called the earnings test. In 2026, if you are under full retirement age all year, you can earn up to $24,480 before they start withholding benefits, $1 for every $2 you earn above that. In the year you actually reach full retirement age, that limit jumps to $65,160, and the penalty softens to $1 withheld for every $3 over the limit. Here is what almost nobody tells you: that withheld money is not gone. Once you reach full retirement age, the SSA recalculates your monthly benefit going forward to credit you for every single month they withheld a payment. Most people who get a reduced check assume that money is simply lost forever, and they sometimes make major life decisions, like quitting a job they actually wanted, based on that wrong assumption. Picture someone who claimed early at 62, took a part-time consulting job, and watched their monthly check shrink because of the earnings test. If they assume that reduction is permanent, they might turn down future work entirely, when in reality, the SSA is essentially keeping a running tally that gets paid back to them in the form of a higher check for every year after their full retirement age. The second thing involves the number that decides your entire benefit, and it sits quietly in a record you have probably never opened. Your benefit is calculated using your highest 35 years of earnings, adjusted for wage growth. If even one of those years is missing or recorded incorrectly, perhaps because an employer made a typo on a W-2 decades ago, that error gets averaged directly into your benefit calculation, permanently. One missing year of solid earnings can lower your monthly check by a noticeable amount for the rest of your life, and the SSA does not contact you to flag a discrepancy. The record simply sits there exactly as filed until someone notices. Correcting it generally requires you to file a request for correction of earnings record along with old W-2s or tax returns as proof. And the SSA itself has acknowledged that billions of dollars in wages over the years have never been matched to the correct earnings record, with roughly half of those mismatches never getting fixed at all. If you are finding this useful, go ahead and subscribe now, because the next 2 things on this list involve money. Some retirees are owed and money other retirees are being told to pay back, and both situations move on strict deadlines that most people miss simply because they did not know the clock had already started. The third thing is about what happens after a spouse passes away, and this is where the SSA's own internal audits have found real problems. When a spouse dies, the surviving spouse can often choose the order in which they claim benefits. They can start a survivor benefit first and let their own retirement benefit keep growing until age 70, or claim their own benefit first and switch to the survivor benefit later if it turns out to be larger. The SSA is not required to walk you through this choice, and a federal audit found cases where widows were underpaid tens of thousands of dollars over several years simply because nobody at the SSA explained that this sequencing option existed. The right sequence depends entirely on which benefit, your own or your late spouse's, ends up being larger, and that is a calculation the SSA leaves entirely up to you to figure out. In one documented case, a widow who turned 70 was found to have been underpaid by roughly $13,000 over just 2 years because she was never told that delaying her own retirement benefit while collecting survivor benefits first would have produced a larger combined total. The fourth thing is the flip side of the earnings test from earlier, and it is far less forgiving. If the SSA decides you were overpaid for any reason, including their own administrative error, they will send you a notice, and as of the current rules, the default is to withhold 50% of your monthly retirement or disability benefit until the overpayment is recovered. You have 60 days from the date on that notice to file an appeal if you do not believe you were overpaid, or to request a waiver. If you believe the overpayment was not your fault and repaying it would create a genuine financial hardship. If you miss that 60-day window, your options narrow significantly, and the 50% withholding can begin automatically. The letter does explain that you can appeal, but it does not always make clear how short that window really is or how aggressively the default withholding rate has changed in recent years. For overpayments under $1,000, the SSA can sometimes process a waiver with a single phone call if you are not at fault, but most people do not know that option exists either, and instead simply accept the 50% reduction starting the very next month. The fifth thing is the quiet rule change from 2015 that most people claiming Social Security today have never heard of, called deemed filing. For most people who turn 62 after a certain date, when you file for one type of benefit, like your own retirement benefit, the SSA automatically deems you to be filing for any spousal benefit you are also eligible for at the same time and pays you whichever amount is higher. This closed off an older strategy where one spouse could claim only a spousal benefit while letting their own retirement benefit grow separately. But here's the part that almost nobody knows. Deemed filing has never applied to survivor benefits. If you are a widow or widower, you still have the flexibility to claim one benefit first and switch to the other later. Exactly the strategy that was closed off for living spouses. The SSA will not tell you that this distinction exists because their letters are written to explain what you are eligible for today, not to walk you through every possible sequencing strategy available to you. For a widow whose own retirement benefit would eventually be larger at 70, starting with the survivor benefit at 60, and switching later can mean years of income now without permanently shrinking the larger benefit she will eventually rely on. So here is the pattern running through all five of these. The SSA's job is to administer the rules correctly when you ask, not to proactively optimize your outcome or warn you about deadlines before they pass. The earnings test withholding gets repaid, but only if you do not panic and make decisions based on the assumption that it is gone forever. An earnings record error can quietly shrink your check for life unless you check it yourself. A widow's claiming sequence can be worth a six-figure difference over 20 years, but only if someone tells her the option exists. An overpayment notice gives you 60 days, whether or not you noticed the letter in time. And deemed filing closed one door in 2015 while leaving a different door wide open for survivors, and the SSA's paperwork was never designed to point that out. None of these five things are secrets in the sense of being hidden on purpose. They are simply sitting in publications, forms, and internal rules that nobody at the SSA is required to walk you through unless you already know the right question to ask. If any of these five surprised you, drop a comment with your age and which one you are going to look into on your own Social Security account this week. And if this helped you understand something the SSA never explained clearly, subscribe so you do not miss the next one, because there is always more sitting quietly in the fine print.